Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, December 6, 2021. What I'll do in this video is start out with an update on the equity markets and then hit on some of the recently highlighted trade ideas. I'll try to keep it in this order: Bitcoin, natural gas, crude oil. We'll look at lumber, treasury bonds, and then gold, silver, the US dollar and euro, and maybe the other precious metals I've mentioned, platinum and palladium, recently looking good as well. And then, you know what, let me make a note here to add to the at the end some of the communication stocks and an ETF that you can trade those. Alrighty, starting out. Yeah, I didn't get anything out this morning because I want to see which way we go, and it might be a while here. What I mean by that is, remember, on Friday we closed right on a perfect test of that 382.80. That was that previous high right there. So it's a major technical level, a significant technical level. Previous reaction high before we had that correction, then the breakout there. So again, all this is a back test so far. So, you know, bulls want to see this, hold that level and rally from there, and that's certainly possible. Bears want to see that level go, and obviously go on a daily closing basis. This is a daily chart, and all that matters is how you close the day. But at this point, you see, we had another run. Remember, we overshot it yesterday. When you zoom down to my 60-minute chart, and what it was is we hit T1 there. That was pretty much that previous high. Then we shot down. We had what I called a momentum fueled overshoot. Remember, we had the bear flag or bearish pennant pattern. We broke down. It was impulsive. So you're going to get that impulsive selling. That's the nature of a bearish pennant pattern. Just like the move down on the flagpole is an impulsive move down, and that's typically what you get. So you got the overshoot of it. You almost hit the measured target. I've always say this: every time I have a measured target on a pattern, if you have a solid support just above it, that's where you want to cover. And if you, let's say your solid support is a hair below it, you might cover there as well. But in this case, that measured target, that's this white line right here, was right smack about in the middle of T2 and then the top of the T3 zone. This is a target zone. I do that when I have you know, dual or a couple support levels in very close proximity. It's more of a target zone, and that's that. So we came close enough. Again, these are unadjusted targets, so you want to cover a little above. So we've effectively hit T2 and then parked it there. And that's everything I covered in last week's update. So again, when you zoom back out to the bigger picture, the daily chart, this is what we're seeing here. And today is certainly a consolidation and another pretty much reaction, if you will. Yeah, so a consolidation right above that level. We went a hair above it earlier, back above it, and you know, we've just been grinding around today, and that's probably what we're going to see the rest of the day. I don't expect fireworks. In fact, I've got to cut out this afternoon. I have to take my 16-year-old for his driving test, so I'll be out probably leaving here a little before about 3 o'clock or so today, about an hour before the close. And again, I don't expect any big fireworks. We could consolidate for a while, and everything I said last week holds true. If you're a bull, you go long at the back test, and if you're a bear, you wait for, at this point, you know, a move back down below there. You know, and what I'm talking about a back test, I gave you an example recently of Netflix. You know, Netflix had a major trading range right there. You had a breakout, a back test, and that was a successful back test, and it set up this trend. But then we came full circle. Netflix is on a sell signal, since we broke down below that uptrend line. It's been moving lower, took out 616 support, and I'm seeing that a lot of stocks have broken support and they're back testing now. So again, bottom line, it could be sloppy for a few days, but I still maintain these downside targets. I think they'll be hit whether the bounce takes us up. Now, where to? Well, that's a good question. Right here, that was a pretty big level, 390. Remember, that was a sell signal triggered. We had a lot of multiple objective shorting ops, including bounces back to 401, and then I set on a break below 390, which you got there, and then you back tested it there, got another objective, probably the last objective short entry we had right there, and then that final thrust down to hit T2. So this is how it works. We're going to probably bounce. We could bounce, hard to say, but I can tell you if we get up to 390, that's certainly a very objective level to short. I suspect we probably won't get there, but again, if we do, that's objective. Otherwise, Let me show you some other charts where we might get some objective short entries. So that's it. We're just a little consolidation here. Let's not read too much more into it. And again, whether we move up or not, and whether this is it, still favor move down to my fourth target, and more so kind of align that with this daily chart as well. This may supersede it. You have a trend line here, and then I think big levels here are the 200-day exponential and simple moving averages, which come in just below that 360 level. So that would be still a swing target. And right now, at this point in time, my max swing target zone down here at about 335, 342. There's a support zone there, and what you'd get if that's hit, I could see this playing out. Again, we need to break support first. We need to take out this back test of this recent high, but I could see something like this, work our way down, hit the trend line, walk our way down here, and when we take out the 200 days, which are right here, maybe a intraday or even an intra-week break below, hit support down below with a momentum overshoot, and then park back on them. One thing to look at is, those 200 days. If you look at this indicator up top here, this is QQQ up here, but just focus on this indicator right here. This is it's a custom indicator I created, and I've shared it before on the site. The percentage above the 40-week moving average. Now I'm on a weekly chart. I also have the same thing on a daily, but we're just going to look at it here on a weekly chart. The 40-week exponential moving average is the same thing as a 200-day moving average, because you have 5 days in a week, so 5 times 40 equals 200. So on a weekly chart, it's the same moving average. And this down here, this yellow indicator shows you how much you're above or below it. So when you're at the zero line right here, that means QQQ is trading on the 200-day. And so what I've done is added this line ever since the dot-com bubble back here, which had some extreme, crazy, overbought conditions that have yet to be seen even since then. We have pretty much since the early 2000s now, so for over 2 decades, it's this 16 level I noted is pretty much has capped advances. Market didn't always stop right there, but it didn't go up from there. That's where it was a cap on the. In other words, we traded the maximum QQQ gets is about 16% above the 200-day moving average, and it's not always a sell signal. Sometimes it stay there for a while, and the market continues to drift a little higher, but you get that negative divergence, and you can see them here, all my divergence lines, and so you get there, then you start diverging, and then finally the corrections come. So after each and every one of these divergent highs right here on that custom indicator, you had a correction. That one was well over 15% back there. Again, I kind of squished the lines, the chart of QQQ up top, but it's just worth noting that when the Fed came in with the nuclear option after COVID hit, that gave us a spike, crazy spike, way above that 16 level. Again, that had not been seen in well over 2 decades, and we had that there. And that was, what happens when you throw trillions of dollars at the both in monetary and fiscal stimulus. But then, since then, you can see we've had some pretty steep divergences. I'm trying to draw the line there, and we're back below it. We've hit it a few times, and we're moving back below it. So again, divergences across the board on the weekly chart. And also, okay, the final takeaway from this is when you get far away from the 200-day, it's normal to come back and test it. So you look at that zero line, again, this denotes when QQQ falls back there. And if you zoom in nice and tight, here I'll just use an arrow tool, you hit it, and there's usually a bounce there. The buyers usually step in. Sometimes you do overshoot it in a correction, but when you regain it, that's bullish. And there's a lot of times, and you can replicate this chart on your own, there's a lot of times you hit that level, especially on the initial tag, and you bounce, or you go slightly through it. Like I said, that's where we may take it out for a week or so, intra-week, or maybe a week or two. But again, traders often step in and buy the 200-day and 40-week moving average. And so that's where I think, said and done, if we did put in a significant top recently in the recent highs, which I think we very well may have, we'll have a better idea by the end of this week. I'll tell you that right now. But that would be a ideal swing target. So look for a move down to the 200 days, which again, you can just go back to the daily chart and see the 200 days. I have them turned down right here in color, but they're the blue and red line right here. So that's it. And again, it's not unusual, especially if you're falling almost straight down when you head towards them. Usually you get a little bit of a momentum fueled overshoot. Sometimes you kiss them perfectly. All right, let's move on. So that's the daily chart, and again, it was not just QQQ. SPY, the S&P 500, widely considered one of the best indicators of the overall stock market. Perfect back test right there. Well, not a perfect back test. We slightly overshot it, but we recovered it. Again, we're back on a daily chart here, so you can see that was a major reaction high back there. It was a divergent high. We had a correction that set in afterwards, and then we came full circle, made a marginal new high, came in, slightly overshot it, but all that is a back test. You know, you're talking a 454 point security at that point in time, and you went, you know, fractionally below it. So for all intents and purposes, this is a successful back test so far. Now we're still back testing technically because we're still within that realm. We're consolidating around that level. And all I can tell you, I can tell you where I think we're going. Again, we're going to probably head lower, come test the 200s on the SPY as well. But this is a battleground between bulls and bears. They're fighting it. Bulls are buying the back test, as you know, anyone who has a longer-term bullish outlook on the S&P should. And bears are waiting to see that get taken down, meaning metaphorically speaking, just talking about those that are flexible traders like myself that will go long or short, and they're looking to see that level give way, because if it does, just like on QQQ, that will indicate that this breakout right here above the previous high proved to be a false or failed breakout after a brief move up. Okay, so that's S&P 500. What makes me think the breakout will likely fail? Again, it's not just, well, this market can't keep going up. No, that's nothing to do with it. It's the technicals, negative divergences, breadth indicators, everything I've covered for weeks now. So that's it on the S&P 60-minute. Here's a potential downtrend line when we zoom in. I'm sorry, that was S&P daily chart, SPY daily. This is the 60-minute chart. So we've been zigzagging lower. Say what you want about where you think the market's going. That's subjective, and you know, some will be right, some will be wrong. But what you can't argue is the fact we're in a near-term downtrend. I just showed you those zigs and zags, lower lows and lower highs. And so there's a potential downtrend line. It's not the best defined trend line, but there's enough reactions. 1, 2, 3, almost 4 there, 5. And you also have some price resistance above it. So we're really close enough, and we have some price resistance here. So you know, it's going to be quite bearish. I'm leaning towards this being it for the bounce. My max bounce target, not that we can't go higher and still keep the bearish case intact, but I really wouldn't want to see SPY exceed that 465.50 right there. That's pretty good resistance. We had a little whipsaw through there, but it's acted as good support. Then we broke it, and it was impulsive, and then we came up, made a back test, got rejected, and it never made another back test, and then hasn't looked back since. So this is what I'm favoring right now. You break that trend line, and you may run up and test that level again. We'll see. I'll keep you posted. And then last but not least, the small caps. Small caps are interesting. Let's start out here on the daily chart. As I mentioned, small caps have been in a year-long sideways trading range. It was very well defined. Well, pretty well defined. The top and bottom wasn't hit each and every time, but you can see it clearly as I box it in there, and that's where we've been bouncing around. And then recently we had a breakout. And this breakout, unlike SPY and QQQ, has 110% failed. That's what a failed breakout looks like. Popped that top of that trading range, came back and failed it. And when you failed it, you didn't just meander around. It was a big drop in the small caps, all the way back down here to about 215. I have it at 214.90, minor support, but the bottom of the range is below that at 208.50 right there, because you had a few reaction lows back there. And for the first time in a while, we're down below both the 200-day simple and exponential moving averages. I'm going to show you them here in case you can't pick them up in the video. The red line right here, this is the 200-day exponential moving average, and it comes in right here. We just took it out. We took it out actually last week, and we've been back testing against it. And the 200-day simple moving average, you know, the only difference is how they're calculated. The exponential is going to move a little faster. It's going to follow price a little quicker. So the 200-day simple will lag, and some traders use that. We're below that, and we're also below the 50-day moving average right there. So all in all, that puts the small caps in a pretty precarious technical position with multiple sell signals or bearish developments. First the divergent high, then the failed breakout, then the drop below the 200 days. But you are still above that year-long or so trading range. If and when that goes, that's going to have longer-term bearish implications. And meaning I think we'll drop, as I think I covered last week, down here from about bottom of that range, roughly 213, all the way down to 171. That's about a 20% drop in IWM. Now that hasn't happened yet, so best we're not that far above there, so you can wait. It's only another 4.5% below, so you can wait for a break of that if you want to position for a swing short all the way down to that 170-ish level. And the reason you don't want to go too aggressively short now, like I said, best thing to do is lighten up over the weekend, because we parked the indexes right on that major support on the SPY and QQQ. IWM does have positive divergence on the 60-minute chart. Let me cover the futures and then I'll move on. Just want to give you a comprehensive. This is a 1-minute chart. Sorry, I was doing a little day trading this morning. I meant to queue up the 60-minute chart. Right here, NQ. Okay, here's the NQ 60-minute chart. The last trend line we broke was this one here. First we broke that one, gave us a sell signal back there. Then we broke the secondary trend line there. So we had sell signal 1 after the divergent high there, put in a marginal new high, and gave you a second sell signal. And then recently we broke this one, which is another sell signal and a bearish development. But we hit, my T2 on the 60-minute chart of QQQ and this 15,536 long-standing target support. In fact, it was the last one I had on the 60-minute chart. Now, I gave you last week some longer-term targets. They're actually back here on the 6-month chart, but that was posted and I think covered in the video last week. This is if things get ugly. In other words, if this breakout right here clearly fails, we're back on it. That's that previous high. So if the breakout of that fails, we move lower, start taking out these support levels. I think we can drop all the way down there about 14,430 on NQ, the Nasdaq 100 futures. All right, so that's how it looks here. Again, positive divergence also on the futures of NQ, so that's why you have to be a little cautious. Usually these divergent lows on the 60-minute charts are often the catalyst, like it was back here, to the move up to new highs, right? And then you get the divergent highs, and that's the catalyst for the next correction. So what I'm wanting to see, and I think will happen, it'll be very bearish in my opinion, is we have that 15,536 support, which was hit almost to the button last week and again today, and then we want to see that get taken out impulsively and see these divergences burn through, meaning the indicators go down and take out those previous lows, and that would be quite bearish. In a bull trend, you usually, again, these 60-minute divergent lows are often the catalyst, or precede the next leg up, and to see them just fall apart and result in anything more than just a snapback rally, minor snapback rally. If we start to move up here, here's a potential trend line. There's not enough tags yet, but there's still plenty of resistance in NQ, including a potential back test of this trend line. So let me just box it in for you. This would be, I'll tell you what, you could short right here. We have resistance at 15,765. I mean, that's an objective shorting at level there. And if you go up to the next one, you can short there. I would short up to, but not above 16,156 right there. That's my max bounce target zone right now. But again, I'm kind of leaning towards sellers stepping in early and taking this market down before then. Okay, here's what my 60-minute chart of ES, the S&P 500 futures, look like. You have an uptrend line that comes off the lows from back here. That was beginning of October right there, and several reactions on it and a couple reactions recently. And so that, number one, we held that. We fell to it, and it's obviously, very obvious support level. We had two tags of it, 1, 2, bounced, and we also put in divergent low. Now we had divergence here. We got a little rally, but they sold into it. See that started to. There was your first sign that a 60-minute divergent low at support or near support. The buyers stepped in, but failed to take that on up, and then the sellers stepped in, took it down again. So we have the same thing right now. We had into this recent low right here, another divergent low on the 60-minute chart. And we have, I'm going to tweak this trend line right here. We have a little potential downtrend line right there. And it's valid right now, or will be if we get a rejection, because we have 1, 2, 3. I like to see at least 3 reactions on a trend line, distinct reactions, to help validate it. So if we get rejected there, then that's going to be a trend line to watch. And obviously, if we can break this trend line right here on ES, and then you got to be careful because right below it you have support about 44.71. But if we take that out, probably going to burn through those divergences, and that would be that catalyst next leg down. Bullish catalyst, obviously break of the trend line, and then this level here. Really don't want to see. Let me give you a max bounce target again, which would just be ideal to say see the S&P or ES stay below. It's right about here. You have these reactions along there about 46.62, but I think it's objective to short anywhere from where we are right now at that trend line up to 46.27. Maybe hold off if you want. You could make a shot there at 46.62, but again, I'd prefer to see, based on where everything is, sellers to step in before then take it down here. And last but not least, this is RTY, the Russell 2000 small cap futures, but we're looking at 2-hour candles, 120-minute chart. They just hit trendline support as well. You have a trend line that comes off all the way back here in July, right there, mid-July. Another distinct reaction and several reactions recently. So you need to see that get taken out for the bearish scenario. However, you have some pretty strong divergences. You have to respect these divergences as long as they're intact. They could, lead to a rally. I don't have every divergent low marked here, but you can see all the divergent highs, including that last one that did the trick. And then, that was our bearish rising wedge breakdown right there. Objective short entry number 1, secondary trendline break, objective short entry 2, 2383 break, objective short entry 3, the back test short entry number 4, and so forth and so on. And then we just started water falling down. So in a nutshell, we had the biggest correction we've had in months. So naturally, buyers are going to come and step in here, especially with a lot of things that support, and also with bullish divergences. So again, we could bounce or consolidate, trade around for a few days, maybe even a week. Hard to say. Or we could turn around and dump the end of today and take those levels out. And if we do, like I said, I'll be out in the last hour of the trading today. But if anything big happens, I'll do an update when I get back home. Okay, GBTC. This one I laid out on that last video of the day. Now, fortunately, I got that video out after everything was closed. Futures had stopped trading, so this had stopped trading. So there was no trade to be made at that point. You couldn't buy it if you wanted it until futures opened. This is the longer term, the weekly chart of natural gas. So I pointed out this major reaction high here. We ran into that recently. That was resistance, and we did so with extreme overbought readings. And I've showed you before, I've gone over this 100 times recently, all the overbought readings, and you can see even the little ones that just hit the 70 level, you always had at least a tradable pullback measured in double-digit returns. And those extreme overbought readings usually turned out to be high double-digit returns, like that one, and so here we are. And then so when we hit that, I mentioned this would be a more powerful sell signal. We took out the trend line. We did. So that's why I was cautiously bullish, looking for just a short-term tactical bounce trade, and it didn't materialize. And it just shows you how bullish. Now, this is an end-of-day chart. EOD means end-of-day, so they're not showing you right where we're at right now. We are at 367 right now in that gas. So we're right down here. This was my pullback target zone. I have a line here at about 340-ish. And then one there about right about where we are right now. So we are at support, and so in that case, maybe we'll bounce. But again, the history shows when we get this overbought, you could have a deeper correction. I still think it'll be contained probably around the low end. I just can't make a case right now to step in on the 60-minute chart. But again, when the candles are printed today, it's going to show, depending where we close, it's going to extend this drop right here. And again, that's the nature of this beast. That's natural gas. When you think it can't go down anymore, it just keeps going down. And when you think it can't go up anymore in a bull trend, it just keeps going up. So anyway, so that's it. Took a shot there last week, failed, should be stopped out. And I'll wait for the next objective entry. Or again, if you have a long-term short position, then again, look to start covering no less than right here, about 340 or so, or at least you can lower stops if you think it's going to go down a lot more. I'm a believer that commodities are in a new bull market, so I don't think we're going to come down here. Back to those lows, so that's why I'd be a buyer in this area here. Crude oil, trying to figure out where the market's going, but as expected, it has corrected with the market. The market's gone down lately. Crude went down, but just like the market, as I mentioned last week, crude put in a divergent low. We had positive or bullish divergences here on the 60-minute chart. I mentioned there's a bounce trade there up to hit my minimum bounce target, which was a 23.6% Fibonacci retracement level right there, up to about 69.08. That was hit. We had another thrust down, but all that did is extend the existing divergence, and it's still in play right now. We're moving up. We're making another run at that level. My guess it'll probably follow, give or take, not directly, not one-to-one, but probably move up with the stock market. We could see a little more upside, but if and when the market takes another leg down, I believe crude will as well. So as of now, we still have these divergences. So again, it's something you just can't be aggressively short, and if you want to be long, that's right now that's working. But bounce targets, well, I'll still maintain that second bounce target zone, 71.20 up to 72, still a max bounce target zone, and that would also come in. You have a downtrend line or potential trend line just above that. If and when it's going to make it up there will likely depend on what the stock market does, but not necessarily. And like natural gas, I was, and still am looking for a significant top in crude right here. So my take on that, again, this is just for people catching up now. I've covered this quite a bit in the past. Major support back here on crude oil. That's WTIC, crude futures, long-term daily chart going back to 2011. That was broken. We had a waterfall sell-off. All the way back in 2018, we back tested that level, violently rejected, back down again. Rejected once again down here. We had a short trade on it there. Crude put in a 60-minute divergent low, and that was a catalyst for this rally, which at the time I believed to be, and it proved to be, a false breakout, just like I'm looking for on the stock market. And so you can see what happened when that false breakout materialized. That was a drop of, we'll measure it out so far, rough estimate here, about a 26, I think it was more than that if I zero in, but about at least a 25-26% drop in crude oil, and we're oversold. So again, so you have the positive divergence on the 60-minute chart. Nothing goes down forever. You can see down here the RSI is at oversold levels, just like it was right here when we bounced at that point. So oversold, oversold, oversold right there, oversold. But the thing about oversold, especially once the trend changes and you enter a bull trend, if that is indeed, if I'm correct, we're going down more, then oversold often does and can become more oversold or stay oversold for a period of time. So in a bull trend, yeah, you want to grab those pullbacks to the 30 level on the RSI. Oversold is often a major buy signal, but in a bear trend, oversold, as I just showed you there, can become more oversold. So therefore, basically waiting to see these 60-minute divergences play out fully or get taken out, burn through, and then we'll probably see the next drop. To where? I'll have to use a 60-minute chart as my guide and the 120-minute chart, which I have been. I'm not crazy about that level there. That's an old line I've had around 55 on crude, but let's just see if we even get the reversal. Let me look at my 6-month chart, 2-hour candles. Oh, that is it. Yeah, I'll get back to you on that. We'll watch this one. As of now, everything's kind of in a little consolidation or bounce mode from last week's big drop. So I'll continue to update crude. Lumber still hanging in there. Mentioned as a short trade idea last week at 86.71, about 877 right there. We had unconfirmed, and it's almost confirmed now. The unconfirmed divergent high gives us this little wedge type pattern. Mentioned a target zone down here, and so stops about 948 right there. So we're a little bit below that, and looks like we're ready to make that bearish crossover. So I think if the market can turn down soon, especially an impulsive leg down, that will most likely bring sellers in for lumber. Why? Because market takes a hit, consumer confidence goes down, consumer spending drops, and then you probably see the expectation for new homes going up, which is the big demand for lumber. That should drop. And again, it's all pretty strongly correlated over the years, lumber prices in the stock market. Although in recent years everything's kind of got funky and kind of done their own thing since the Fed came in. But again, it's first and foremost the divergence that's been building here. I think it'll play out just like it did last time here. Divergent high, nice little drop. Gold, I'm still longer term bullish on gold. It's still intermediate, it's been going all over the place. Again, just to kind of recap, there was a big level there. Over time, the futures have rolled, so it changed. That level now is about 1840. It was pretty big resistance. We took it out there, which it was at time on face value bullish, but then, like I said, I didn't like the fact that mainstream media, financial media started getting all bullish on it, and I thought that trade got too crowded. They got bullish after the big run. Plus, we put in a divergent high right here, and then we broke down off that bearish rising wedge, and then the breakout failed, and so it's brought us back. But look at this, we're at uptrend line support. We still have the bottom of the support zone. It's a sloppy trading range, a multi-month trading range in gold, but there it is. It's still there. Enough reactions down towards the bottom of it. With just these were whipsaws. We went through and then right back up in there, and that's why I still maintain, this is the bottom of the range. So we're towards the bottom of the range, but above this uptrend line support, big divergences. These divergences right now are comparable to these divergences we had here, and that was good for a rally off that divergent low of about where's my measuring tool popping up? Oh yeah, about 9% there. And so if we can get that, it's going to take us back up above that 1840ish level again. And what do we need to see that happen? Well, I'll get to the dollar in a second. Let me show you silver first while I'm on the metals. SI, where are my silver futures? Give me 1 second. Got them down here somewhere. There it is, SI. Still setting up. Look at that. Nice positive divergence, just like you had back there, right? That was a nice trade off that divergent low. And then, like everything else, come full circle. Nothing goes up forever. Put a divergent high right there, negative divergence. Had a correction. Now we have this bullish falling wedge pattern at support. Need to pop it. And then we pop it. We're going to run up, hit at least those two targets, and quite likely more. What's going to have to happen? Well, we'll need to see the euro take out this secondary trend line. We already had a breakout on this bullish falling wedge pattern right here. Powell, as I've been saying for, gosh, almost a year now, was in just complete denial. Just wrong. Let's not say denial. He was just wrong with his stupid transitory inflation call, and he's now finally backpedaling, clearly backpedaling. But the ECB is not, and they will. And so what happens? What I mean by that, if you follow where I'm going, is when the Fed becomes hawkish, that's bullish for the dollar. He's already tapering the bond program. The dot plot for interest rates is already sharply increased, meaning the expectation of rate hikes, which will follow the bond purchase tapering. And let me change this color on this tool here. So we've been the dollar's been rallying, euro's been falling. However, we broke out recently. We had this breakout. It was impulsive. We've been moving up, higher lows. There's our uptrend line right there. It forms this little triangle pattern. Boom, euro needs to pop that, and then pop 113.78. And we can get a nice rally, and I think we will, up to about at least 115.45. That's a near-term target. That would be bullish for gold and silver, should give them a boost because they are positively correlated with the euro. Likewise, look at the US dollar, that is DX, dollar futures, the dollar index. Sometimes this chart needs refreshing here. You have an uptrend line right there that needs to crack. You can take that uptrend line out. And remember, just like the euro put in a bullish falling wedge, divergent low and broke out, the dollar is an inverse chart of it. Put in negative divergence, so a bearish rising wedge, break down. It was impulsive. And there it is. So now we need to take out this secondary trend line, and then all the better when we take out 95,536. So that's my trajectory for the dollar. I think it'll come down here. Let me give that level if you want to trade it directly. They have ETFs and ETNs, but you got to put so much in them because they're not leveraged. That's why you want to trade Forex or futures here. Anywho, that's my target there for the dollar. First target, and again, with the sell signal come there, and that's what you want to see if you're looking to get into gold, or if you're in gold now. We need to see the dollar break down and the euro breakout. And sticking with precious metals, I mentioned liking for at least a bounce trade, though I've been longer term bearish on palladium since way back, well, to the left of this chart. Got most of that drop, got bullish on it here for a bounce trade. It did, and now recently, last week or so, mentioned as a having bullish divergence and a little trading up. Now we already hit that 1877.86. That's really my minimum target. But I think if we can get that momentum in gold and silver going, we could swing all the way up here to that secondary target at 21.43 roughly right there. And that's PA, Palladium Futures. PALL is your ETF. And I've already covered that in some of the recent videos, so I probably laid out targets for you there if you want to trade the ETFs. And then platinum as well. So these are your major precious metals: gold, silver, platinum, and palladium. At least the ones I like to trade. And where is my PL? Let me get that for you guys. Here it is. PL. Not running yet, but poised to run. We have this bullish falling wedge right here, positive divergence, breakout. And at the time, I told you the other day I was holding off because I said we have a reaction low there, and I was leaning towards a back test of the trend line and showed you that we may drift down a little. I said you could take it here, down to here, but not below. And so it's still, we're about where it was when I mentioned it the other day. So if it rallies from there, you're about to my target zone. You're about a 7.5% gain. If it drops a little more and you buy it down there, almost 12% gain down, anywhere near this previous reaction low right there. Okay, last week I mentioned what was to me one of the most attractive sectors, or some of the individual stocks out there for long trades, were some of the communication stocks. I mentioned T-Mobile, Comcast. Somebody asked about AT&T, and I said, yeah, that too. And now often I'll cover XLC because that's the Spider's communication sector's fund, ETF. And although it does have those companies, I believe they're all in there. The problem with it is it's so heavy weighted. I haven't updated this in a while. It's been over a year, you can see, but yeah. But it's always been very heavy in Facebook and Alphabet. Back then, a year ago, a little over a year, they made up almost half the entire returns. Ridiculous. No diversification. So if you're bull on Alphabet and Facebook, yeah, you buy it, or now Meta, whatever they call it. But you can see the bounce has been muted because of that, and this kind of was my theme. The fangs have finally started rolling over, and so live by the fangs, die by the fangs. When you're in an ETF that's overweighted, the beloved market leaders, when they're doing well and they're doing the majority of the lifting in the market, like I've talked about recently with breadth deterioration, great. But when the tide turns and they start going down and they're lagging, you can see that the bounce has been relatively muted. So the other one, it's more of a direct play, and I'll talk about it in a second whether there's more upside or not, is this one here, IYZ. You can see it's had a better bounce, and the charts look a lot more like those I mentioned last week. So again, it consists of, among other things, but before I leave it, let me just show you coming up to resistance. So I expect at least some consolidation there. If these stocks continue to get some traction, just like the ones I mentioned last week, it has positive divergence here, at least on the PPO. But the ones that stood out to me were Comcast, and up again today. Comcast put in that divergent low, broke above the trend line and that 52.22 level today. It is below all its major moving averages. That's something to realize too. So this is, if the market is going to roll over, these guys aren't going to go very far. But again, I told you, if you're a bull, you think the market's going higher. If I'm wrong on my market call, this sector looks better than most others right now. So that's where I would be if I was looking for new highs in the market. I'd have at least not all my money, but some of it in these guys. But they are below. I just showing you here the 50-day, 200-day exponential, 200-day simple. They broke down below there recently. So you're going to have some resistance overhead plus price resistance right here. So there's Comcast. I think it can run up maybe to about 54, 58. A little more upside. But if the market can hold up for a while. And then Verizon, same thing, divergent low right there. AT&T, again, covered last week, mainly on the long-term chart. Made the case there. I think I covered that in the videos Friday, so I won't spend any more time. But all up today. T-Mobile, one of my favorites. That was the first one I highlighted in the video. Nice move today, up another 2.5%. But at that 115.65 target already. So you could take quick profits there, or look at the charts longer term. That's a bullish chart. Doesn't guarantee it'll play out, but if it does, next stop I have on the stock is all the way up here about 124.50. Let me see if I left any out there. No, I think that's it. Okay, let me wrap it up here. And again, covered everything I wanted to do an update on. If I missed anything, I'll get another video or some charts out to you. And again, if anything big happens today into the last hour of trading, I'll do a follow-up video or get some charts out to you when I get back to my desk later today. This has been Randy Finney with Right Side of the Chart. Have a good one.